Investor Place does it again. They say we're not out of the woods yet. There's not any other breaking news that I would say, and also there's a lot of actually good information that we can go over. Not necessarily good takeaways from that information, but the guy himself has good information. We're going to go over this article in pretty heavy detail. We also got a couple new filings to go over. Institutional ownership very close to 19% now. And the financials. We're going to go over this when I'm actually debunking some horrible claims. Like usual, there's always horrible claims. There's always stuff that these analysts look at. They get halfway there, and then they just forget to do a whole nother step of the thinking and the extrapolating and looking at, for example, the expenses and why they're so high, or the revenue, or comparing it to other quarters. You'd think comparing our revenue this year to other years should be simple. Apparently it's not, though. You'll see what I mean here in a little bit. But we're going to go over the revenue in the last couple of years, the financials, the quarterly report, how we're on track. What is our revenue looking at right now for 2021? What is it? How's that compared to 2020 and 2018 and all these other years? Because we have got the offerings in, we've got the marketing, and the C-suite is new. We've got new members there. We got the CMO, the CBO, CCO, a ton of new things. Lineagen is now with us. We better be making some gains here. This article doesn't really. I guess they weren't smart enough to look at a damn Yahoo Finance financials and see how much we've got in revenue. It's pretty simple, but we're going to go over it and debunk some shit when it comes to that, along with going over some of the earnings takeaways and some stuff that this guy missed. So, and we'll do a small amount of technical analysis, I'm sure, as well. And with that being, and my portfolio showcase, of course. Starting off with the institutional ownership very quickly, we're at 18.68%, and you got a couple new filings here. Nothing of note, really. All right, you got, you do have one interesting filing. I would say if we go down here, you got almost 1% portfolio allocation. It actually just happens to be the same institution that has the 4% portfolio allocation in us as well. It's not this. It's the same DWAS. Invesco momentum ETFs. It's like in the same branch as that, the same vein, run by the same overarching corporate, or whoever it is. So I think, to my understanding, so that's the only interesting one. Everything else is very low portfolio allocation. There's a lot of shares being added. Institutional ownership has skyrocketed. It's good, slightly bullish, not crazy though. All right, now more into the more interesting stuff. This article was written by the same guy, and I don't have it. I have it on a Google Doc here today because I can't actually look at the Seeking Alpha article. But let me go ahead and find a picture for you of the guy, because this is the same guy that made a crappy article the other day actually on us. It is this one right here. Okay, now if we just look before it kicks in here, this guy, yeah, you can see the guy. This is the same one that did the other crappy article the other day. So he is giving us his takeaway on earnings. And if we just go up here to the summary, you can see very clearly what he's thinking. And a lot of his points I like, but he just misses a lot when he makes a little bit more of the bearish ones. He misses a lot of the point. He misses a lot of the facts. And we're going to look at the historical data today to prove him wrong on a couple specific ones. So first point is that BNGO remains a speculative trade. After Q2 revenue fails to give a solid signal of the medical community's acceptance of Sapphire. We're talking about the same Q2, right? The 226% year-over-year growth. Oh, I know what he's going to say. He's going to say it's a distorting figure. It's misleading because Q2 2020 was so shitty, and it doesn't count. Plus, we have Lineagen. We didn't have them before. If you actually look at the data, though, you're going to see exactly what I mean and why this is a horrible argument. Okay. The mediocre performance is by no means a thesis for shorting the ticker, given the company's robust balance sheet and commercial opportunity for Sapphire. Great point there. I completely agree. Okay, if you're shorting the ticker, you're asking for death. I mean, if you don't understand the business model of us, maybe you want to short, but if you do, you don't want to short. These company dynamics render BNGO a fully valued stock. Upward, and that's the key point. They think we're fully valued. They think this is our true value. We're at our true value right now. So, they're not super bearish or bullish, right? They're saying we need to stay where we are roughly, or at least fundamentally we should, until we get some revenue data coming in, some new stuff, some new data coming in to prove that we really are going to get huge community acceptance of the medical field or not. Upward revision rests on management's ability to deliver high growth in terms of revenue, but more importantly, Sapphire's installed base, which is funny because we doubled our installed base on the quarter compared to last year, right? Or actually more than doubled. And if you look at the DCF here, if we look at the DCF here, this isn't even that important of a point. I'll make it real quickly though. If you look right here, we're only going to get more Sapphires installed. And this is something that no one cares about, right? Like, let's say the trajectory that Sapphires being sold is going to be lower than a 63% CAGR. Let's say we're going to get I don't know, let's say we're only going to get 140 Sapphires installed this year, and it's not going to be as much as we thought. Guess what? We're still going to be profitable. We're still on our way to billions in profit, and the reason for that is because as long as we're getting more in Sapphires installed, the consumable revenue is only going to fucking skyrocket. Our product sales may not go through the roof as we're expecting, but we're still going to be on the way to profitability. That's not disputable, okay? And that's the beauty of the business model. It's very safe with a company like this. In my opinion, at least with a business model like this, it's very safe. It's the ink and cartridge type of thing, right? It's the reoccurring parts of the revenue to the business model. It's safe to hold this stuff for years. It's safe to say. It's safe to hold, man. All right, so if we look at this article, there's a couple of specific points I want to go over here. This is where he gets it completely wrong. Now, before this, he goes over some reasons. He goes over why the year-over-year comparison is distorted. Fine, you want to make that argument? You got a couple good reasons there. Go ahead. Okay, fine. It's a little bit distorted, not completely, right? 4 million on the quarter is much higher than 1 million, right? Can we agree? Okay, it's a little bit distorted because quarter two was the pandemic. We got the COVID action going on, and then we didn't have Lineagen, right? Okay, there's a little bit of distortion there, but what he completely misses is this right here. This is what he's been building up with the last few paragraphs. This is what he means to say with all those reasoning and all that digging that he just did. Even in absolute terms, revenue is not significantly different from previous years, especially given the low market penetration and low revenue compared to its product mixing. A small number of Sapphire sales creates considerable percentage change given the low revenue levels. All right, so the problem is obviously we know if we look at the historical data, it is the 2021 revenue. Right now, I mean, yeah, 2021 revenue is significantly different from other years, easily, obviously. Okay, now if we just do some basic, if I can do this math, you can. I promise you. All right, so if we look right here, you're looking at $7 million in total revenue if you combine the first 2 quarters of 2021, right? Quarter 1, quarter 2, 6 months ended June 30th, 2021, you're looking at $7 million. And you're like, okay, Brandon, is that right? Did they mess something up? Are you sure? Well, if you just do some basic math, right, we got 3.9 million last quarter, and then the quarter before that, we got like 3.2 million. That adds up to about 7 million. And you may ask, Brandon, what's the comparison here? What did we do last year, the first half last year, or the year before that? Or what did we totally do, right? So you guys have to understand here, in this comparison we're about to make, quarter 4 and quarter 3, on average, for Bionano and a lot of companies in a similar field, in the genetic field, cytogenetics as well, they do better in the later quarters, especially quarter 4, because that is when, for one reason or another, that is when labs are going to be using more of their budgets or have a bigger budget, right? Okay, one of the two or both, right? They're spending more money, and we are just think of it this way, okay? Ape language, quarter 4 is our best quarter almost always, and you can see that. Okay, where's the proof, Brandon? How do you know this? Well, just look at the last year, 2020 quarter 4. We got way more than we got these last 2 quarters, right? Go look at the data on that if you don't believe me. All right, now if we do our comparison, 2020, you're looking at, and this is according to Yahoo Finance. Okay, this is reliable information. 8.5 million. 8.5. Brandon, 8.5 million for the entire year of 2020. We almost have that this year in 2020 through 2 quarters, and that's not even considering the quarter 4, which is going to be getting a huge boost from the labs that are actually using their budget this time around, right? Wow, that's crazy. Well, hold on, Brandon. 2020 was the COVID. That might not be an accurate comparison. It might be distorting it, right? Like the freaking dummy says. Okay, no disrespect to him. Okay, he does a decent job. He does better than many other analysts, but you got to be able to do. If you're going to make this take, you got to be able to look at the data here. All right, so 2019, you're looking at 10 million. 7 million. Remember, this is 4 quarters. This is a whole year that we're going off right here. This is 4 quarters. We are going with 7 million is what we got in 2 quarters, right, for Bionano. So if we just double that, I'm going to be extremely conservative. We should do more like a 135% or 150% increase of this figure, of this number right here, because quarter 4 is going to be higher, right, because the labs have a higher budget, as I've been saying. But I'm just going to be extremely conservative and say, let's double this. Because that's 2 quarters. We've got another 2 quarters for this year. Let's double that. Let's say what we're on track on for, right? Conservatively, 14 million. 14 million is significantly higher than what we got in 2019. Okay, now that's not a distorted number. Now, if you go right here, 2018, that's 12 million. It's still 14 million, which is 2 million. That's still significantly higher. And then 2017, 9 million, 14 million is still significantly higher. Okay, so there's a clear trend. This year, 2021, obviously, I don't understand this man when he says this. This is crazy that he thinks it. He hasn't looked at the data. He hasn't looked at the data. It's clear that 2021 is on a different path in terms of revenue. It's easy to say. And our little math that we just did there, that is literally without taking into consideration how big the increase in revenue in quarter 4 and quarter 3 is going to be, not only because of the install base that's higher, not only because of the higher consumable revenue, not only because all that stuff, but above all that, the labs spend more money, so it's going to be higher sales, consumable revenue, rentals, installments, everything. Lineagen's going to be better even. Think about that, not even just the Sapphire, Lineagen as well, our subsidiary, the company we acquired. This guy has the audacity to come out here and say, and this is an important point because this is, people will really listen to this stuff because he's getting charts in here. Unfortunately, the charts don't make sense when I copy and paste them, but he's giving reasoning. He's followed the stock for a couple weeks or months at least. I've seen this guy make his articles before, and they're always missing something. They're always missing something, but they're not as bad as a lot of them, so I'll give him that. However, people listen to this. He's trying to substantiate his arguments here, and unfortunately, he just misses all of the data, which is there's an average of about 10 million, 8 million, 9 million, somewhere in that range, or maybe 11 million, right? Probably about 10 million average for the last 4 years, and we already are on track to get 14 million, right? Easily, probably more like 15, 16, 17 million for the year. Yeah, so, it's also, let's just, okay, I think I made my point clear on that, I hope. Ape language, this article, this guy is making the case that 2021 revenue is not significantly different from previous years. That's not true. It is significantly different. It's very, significantly is it's like understating it. You need like a more emphasizing word there because it's absolutely, there's no wonder why 2021, why all these bulls and why people like us are excited about the company's future without even we got a pretty significant revenue, as we expected. Without even getting into the 4 million range, we're still on pace to kick and to have a kick-ass year on revenue. That's as simple as it gets. All right, next point here. I think I've ranted long enough on that. Let's go down here. Okay, so non-financial operational metrics. Talks about how the CEO leveraged her connections in the industry. She's getting a lot of clinical success. The clinical trial success so far, like a lot of progress, right? It's bullish. I agree completely. Clinical trials, I think they pretty much everyone that's been following the company is now realizing these are going to be of more importance than we think. We have to get the knowledge out. We have to get papers and data and articles out on the Sapphire and how it works. That's the biggest way to get huge adoption, right? That's the way to do it. Prove that it does what it say it does, and prove that these people are losing money if they don't switch to Sapphire. So he says the product shipments have been disappointed. BNGO shipped only 13. He says that's bad, which is somewhat low given the market size. Okay. He says there's a ton of market. Okay, I'm not really. It's too early to say that's low. If anything, that's higher, right? It's more than double. It's over 100% higher than what we got in 2020, which is slightly distorted comparison, but still not completely. Double is still huge. Okay, I like that we're making double the Sapphire installments, right? Let's just keep doing that every year, and we're slowly going to get the profitability, man. That's as simple as it gets, right? Even if we were only to get yeah, every single year, that's fine, right? It would take a little bit longer what we're expecting, but still, that's the beauty of the business model. You can just hold for years and know that eventually the $60 to $100 share price potential by these guys, which would be 900% to 1,900% on the far side, that is possible in less than 9 years, right? Literally. And that's serious. And that's what go look at the freaking data, man. Go look at the numbers. It's all there for you. All right, now if we look down here, okay, he's talking about the revenue per device. It's only 44,000, which the range estimate is 75 to 150,000 annually. That's a little bit, they consumable revenue remained flat in the past 3 quarters. He's only doing this on the past 3 quarters, not the entire year. And not he's not gonna. This is kind of a little bit of a bad model here, to my understanding, that he's actually calculating $44,000 per device, where 75,000, 150,000 annually. And this is actually bullish if you think about it. And it's hard. I know there's like 1,000 things here, but what I'll say is that this 44,000, this means that for the last 3 quarters, consumable revenue has been relatively low compared to what we were expecting per device, like per capita, if you will, maybe, right? Ape language, right? Per device, it's low. Once that kicks back up, like we're expecting, like maybe Q3, Q4 it will, because labs are going to spend more money, do more volume. Maybe the Delta variant helps with that. Maybe plants being analyzed, their genome being analyzed, maybe that helps with that. This is going to increase, and imagine if that were to double. Consumable revenue is going to double. That's huge, and a consumable revenue is over. That's over a fourth. I think it's closer to a third of our revenue. And typically this quarter, I think it was like over 1 million, slightly over 1 million, or last quarter, I should say, for Q2. And so that would be huge. So that is actually, believe it or not, this man just made a bullish thing in a way, right? In a sense, this man just said a bullish thing, and he's saying that is not. He's kind of implying this is not good, right? So if we go down here, let's see what else there is. Nanochannels, he's saying they are small. Okay, this is actually higher than what we had last quarter. Okay, this was 2,600 last quarter. Nanochannel, the flow cells that we sold last quarter, it was, or Q1, it was 2,600. Q2, we sold 2,742. Not a huge difference, but still, we increased. Another thing that he doesn't mention, conveniently doesn't mention here, is this. If we go right here, the gross margins. Also, actually, before we go to the gross margins, let's just go right here. Okay, he's talking about, at the start of the article, he said we're not getting huge adoption. The diagnostic realm is still open to us, but we're not really seeing any clear momentum there. Well, if we look right here, we actually have already, right? We've already gotten into one of the largest commercial diagnostic keyword companies in Europe, and another cutting-edge company developing cancer diagnostic assays. That is bullish. That's good. That is what you call momentum, my friend. That's not what you call mediocre. No. That is big news right there, right? The earnings report, by and large, I've said this time and time again. I'm going to continue to say because this is very important. The earnings was good. It was not amazing. It was definitely good, though. He again says that this should not, all his data and his opinions lead him to believe that this is not a shorting thesis. That we are not a company that's worth risking shorting, because it's just not. We have too good of a financial position, and we have too much of a realistic possibility of literally taking the market that we're in by. We're going to have thousands of Sapphires installed. We're going to be making billions in revenue, literally. And that's what's on the table for us. And shorting that doesn't seem like a smart option to this guy, wisely so, right? I wish he would look at the historical revenue to see where he's so wrong in his opinion here. To my understanding and in my mind, right? Financial position evaluation, right? Cash decreased by $30 million during the second quarter, and $17 million in that, 17 million of that was because we did a debt repayment. So that's actually great. That's actually amazing. And also the operating expense increase was primarily because, as we know, it was because of 3.7 million of that was in headcount expenses, adding people, 37 new heads on the quarter, right? That's great to see. And that's actually going to continue. They're going to continue hiring a ton of people, including a 1.4 million increase that was the stock options that were incentivizing the employees. So that actually makes me feel better. Okay, so I didn't actually know the exact number before this, but 17 million debt repayment in the quarter, that makes me feel a lot better about the $30 million loss on the quarter, which was a little bit more than we were expecting. So that makes you feel very good, because 30 million loss on the quarter, that's not, usually we're losing in total on the year, we're losing about 30 to 40 million. And that's kind of what we're expecting this year as well. So that was a lot. However, we're hiring a ton of people. We're doing a ton of marketing. We've got the COI lab that's underway. Quote, we got the clinical trials CMO, our Al Kachabi, doing great things there, and we've got a ton of things going on. Right, there's plenty of things that I'm forgetting. So there are good things happening, and the company is trying their best to expand. They really are doing everything they can. From what I can tell, the company's worked their ass. Last quarter, they have worked their asses off, and there's no reason to believe that's not going to continue. They've got the cash to do it. They've got the product to do it, and they've got the business model for it. Simple as it gets, man. Summary: BNGO successfully reversed the downward revenue trend in recent quarters. However, it is still too early to draw conclusions on the medical community's acceptance of the device. Progress is slow. Really? Is it? We're already... I mean, you guys, okay, please rewind and watch the little math, like very basic equation that we did that was just doubling the revenue that we've got this year so far in the first half. You're doubling that, right? So because there's a half left, and then comparing that to what the other years stack up, and we are the highest by over 2 million in every single comparison for the last 4 years, literally. And he says it's not. I don't understand. I guess he really just hasn't looked at the previous years. Anyways, the progress is slow, especially given the market size at this point. The ticker remains speculative, and we are starting to see a third option between the two extremes of acceptance: a limited adoption to Sapphire instead of super great adoption or no adoption, a limited adoption. And guess what? If it is a limited adoption, great. That's obviously not what we want, not what we want precisely, but that's great because we're only gonna get closer to profitability. And I'm telling you guys, if you hold this for years, there's an extremely high chance that you're gonna make a lot of money, and you're probably gonna beat the market, right? And probably in a big way, even if we're gonna see limited adoption of Sapphire. It's because the business model. I'm not gonna explain it again. All right. There is no clear trend yet, and I believe the third quarter will provide more color on the company's direction. So, ape language here, what I'll say is that the earnings report was good. Our financials look good. Our 2021 looks good. The revenue on the year looks great compared to last quarters, and that's what this guy misses, and that's why we're getting another bearish article by this idiot, in my opinion, right? I'm sorry, but if you're going to... This guy does so much great work on most of his stuff. He looks at great things, and then he says 2021 revenue is not significantly different. It's like, bro, really? I mean, it's obviously it's very different, you know. So I mean, that's just you know, anyone, even a new investor can find that out. Just look at the data, just look at the previous revenue, and look at what we have this year. It's very clear. It's very clear. So, with that being said, the ape language here is that the financials and the earnings report is good, and this article is slightly misleading, however, not as bad as they usually are. Okay, and with that being said, let's go over some quick technical analysis here. So, technical analysis standpoint of things, let's maximize this so you can actually see what I'm doing. Basically, we're getting rejected, and we closed right at 632, right literally 1 cent below the 633, 61.8% Fibonacci level, seeing a little bit of resistance there. However, we have a breakout, and we have a bullish, we're in bullish territory now, short term, and I say that because we have a descending wedge, obviously, that's a clear descending wedge, and the price target is all the way up at 727. I don't know if we're going to hit that, but we broke out, and now we're on the way, I would argue, to at least hitting at least some bullish momentum. But at the end of the day, it's going to depend on whether high growth gives us the chance to hit that price target. And one reason why I was saying earlier that I think that I'm maybe going to slow down on the streams, which I'm actually not going to. I'm actually just going to go full steam back in because everybody. I don't know, but I'm going to go back. We're going to be going back to normal streams this week. But one reason why I was saying we might want to slow them down is because the earnings report that we recently just got, it basically said that the company's on track, they're doing good, slightly better than expected, expenses are higher, but nothing crazy is going to happen. You know, there's nothing crazy that's going to happen that's going to send the stock price way up or way down, most likely. And the only thing that can do that, right, not in the company's control, is high growth. And that's the reason why we're going to be streaming, because high growth has already sent us way up, right? We went down to 550, and now we're all the way up at 632 in a couple trading days, literally. So we're going to go back to covering that, and that's the point. High growth is going to be very key to this. You guys know I'm holding a little bit of UVSY just in case, but we're in bullish territory. I mean, we've broken past the 21 SMA. We confirmed as support, and last time we did that, we went up. Let's see here, $5 to $9. About, what is that? 70%, over 70%, probably closer to 80% in two trading weeks. Okay. So, who knows? Maybe this is the next start of the uptrend. It certainly looks like that from the technical perspective. If you look at the Supertrend SAR, it's not looking as good, actually, believe it or not. That's actually very weird that it's not looking like that, but the 21 SMA is your best indicator. Okay, this thing is very accurate in my experience, and if you look at the history, this has been a great indication to bullish or bearish territory. Right now, we're in bullish territory, short term. Okay, so here's a portfolio. Let's go ahead and unlock the account real quick. Let's switch accounts. Okay, let's do this first because I can't do it the other way. All right, boom, boom. And feel free to check out Newsweed. They are our sponsor. Newsweed, link in the description to them. And there's the portfolio. This is not financial advice. I will see y'all in the next one.